Almost everyone is told the same thing about money as they get older. Shift more and more into bonds. Get conservative. Play it safe. And for a lot of people, that advice is quietly setting them up to cost a fortune. And I understand why it's the default. It feels safe. It's simple. No one ever got criticized for telling someone in their 60s, buy bonds. But playing it safe and being safe are actually two completely different things. And the standard glide path that most advisors are recommending confuses the two. I help people invest every day, and I keep seeing this blanket advice to get more conservative with age, and it's doing more damage than almost any other rule people follow. So in this video, I'm going to break down why getting more conservative as you age is often the wrong move and what we actually do instead with the people we work with right now. So how did we even get to this point? Well, first and foremost, we have compliance teams and cookie cutter investment advisors who have said, let's just take a simple, they fill out a risk tolerance questionnaire and it spits out what exactly they should invest in and they put them in that. And it really plays into this fear of, the sky is falling, so let's get ahead of that. Let's be more conservative over time. And here's a visual to kind of map out what that actually means, this glide path investment philosophy that most advisors are taking. Typically, it's all centered around some age. That age is usually 60. And so in this example, if you're 40, this is how you're invested. I got fixed income, which is bonds, and I have equities, which is stocks. And even at 40 years old, they're often recommended, 20, even in this case, 30% bonds. And then as they get closer to 60, they have more and more bonds. And by 60, they have the traditional 60-40 allocation, 60% stocks, 40% bonds. I don't understand why at 40 years old, especially in a retirement account, where I see this the most prevalent is in retirement accounts, and why in a retirement account you would own 30% bonds when you are 20 years from even legally being able to pull the money without penalty, and then you're another 20 to 30 years of spending it. So we actually have a time horizon on a majority of the money of 30, 40, 50 years. So what happens is this is like putting a parachute on your back, but you're running. You're not actually afraid of falling. You're still putting money in. So why in the heck are you afraid of falling when you're actually running? And that just slows you down. Doesn't actually make you safe. Now hear me out. I am not anti-bond. I am anti-overuse of bonds. So this is the traditional methodology. So where does it really break down? Let's go deeper. It often ignores how long you're going to live. So it's again centered around this specific age, but then you've got 20 to 30 years more life beyond 60. And so it really allows for inflation to creep in and erode substantial amounts of wealth. And the worst thing about it is it's quiet. You don't know it's happening. Now, mistake number 2 is we see that age and risk are the only variables that are considered. But what about taxation? We just talked about inflation, longevity. How much passive income do you have? This all plays into how someone should invest, and it really proves the need for full picture financial planning. We find that most folks have not had their investment philosophy and investment methodology based on full picture financial planning. We find that most folks have not had their investment philosophy and investment methodology based on full picture financial planning. Your parents and grandparents have lived to 100 plus. High likelihood you're going to live to 100 plus. That is a very different investment strategy than if your grandparents and your parents all didn't break 80, which again has really nothing to do with the age 60 center point. Now I'll expand on how we think about that here in a minute. I want to talk about the third major mistake that this glide path way of investing makes. It confuses volatility and risk. This is one of my favorite things to talk about. Risk and volatility are not the same thing. Volatility is the up and down. Risk is the probability that a chosen action will lead to an adverse outcome or undesirable result. So if I'm 60 years old and I put my entire retirement in cash, that is risky. I'm guaranteed to lose money every single year. Inflation will be higher on average than what my cash is earning. So I am losing money every single year. I don't know how that doesn't play into the exact definition of risk. It has no volatility, but to me, you put that out 20, 30 years, that is really high risk. So volatility and risk need to be separated. We need to look at them differently. So here's the crazy truth. Most conservative, really conservative investors actually are often mathematically the highest risk. They are choosing to take on the highest risk, as crazy as that sounds. So what should we be doing instead? There's basically two phases of an investment life. One is the pre-retirement, going up the mountain, and the second is retirement, going down the mountain. When someone is in pre-retirement phase, we use what we've coined as a job description-based investment methodology. We are investing on the job description of that money and that account, not purely just your risk tolerance score that then we blanket across every account. If we're saving money for a second home, that's going to be invested very differently than money that is for retirement. I should not see, Tesla stock likely in their second home account, but I could in their retirement account. I can't have a lot of volatility in that account. Now, notice I don't say risk, it's volatility management. And so we'll have clients with 4 or 5 accounts and they all have different job descriptions. So naturally, those dollars that we are using for retirement, they're going to be really aggressive. Even when they're 40, probably have no bonds, as that mathematically doesn't make sense for the job description of that account. But we might have a ton of bonds in that second home account. Okay, now let's talk about once they're in retirement. We follow a methodology called time-weighted asset allocation, which another cute way to say glide path is risk-based asset allocation. So let me explain to you time-weighted asset allocation. It's a 3-step process. Step 1 is we need to determine the annual need. We do that by saying, what do you want to spend every month? In this example, we've got a $10,000 a month spend rate desire, but we have $5,000 a month of passive income in Social Security. So we actually need $5,000 a month from their investment accounts, which is $60,000 a year. That is how we reverse engineer into step 2, which is how many years of cash do we want? How many years of bonds do we want? And that determines the rest into stocks. So let's do 2 years in cash and 3 years in bonds. That's going to be this example. That's a normal kind of moderate, slightly conservative way that we could invest for a retirement strategy. So in this case, I have $120,000 in cash. That means I have 2 years if the market dumps. I got 2 years of, I'm not pulling anything from the market. Then I've got 3 years, 180 grand of bonds, in which are usually historically not directly correlated to the market. So I am well hedged. I have 5 years of money of spend out of the market, out of that volatile, and notice I didn't say risky, out of that volatile roller coaster of the stock market. However, once I have 5 years or more out, really inflation is my biggest concern. It is not, did the stock market go down or up? It's inflation. And that's how we reverse engineer into the amount of money they should have in cash, bonds, and then stocks. Now, step 3 is where do we hold those dollars? Where do we hold the cash? Where do we hold the bonds? Where do we hold the stocks? That is entirely dependent on a full picture financial plan, or we might be using tax deferred accounts, might be using taxable accounts, and ideally, in a perfect world, we have tax-free accounts. So that is time-weighted asset allocation in a nutshell. What we find is that most people, when we do this exercise, they're actually spitting out an 80-20 mix rather than the traditional 60-40. So the problem with 60-40 in this example is that might produce me almost 12 years of safe money. At that point, inflation has come in and ransacked a ton of money out of my long-term wealth because I've now gone so conservative that I've added the major and most constant risk that people face, which is long-term inflation. That is the elegance of time-weighted asset allocation. So now that you've seen why getting more conservative as you age is often the wrong move, from ignoring how long you're going to live to treating age and risk as the only variables, as well as confusing volatility with risk, you can stop following that glide path rule of thumb that's quietly working against you and start matching your investment philosophy and methodology with your actual life. So if you want a real plan built around your specific situation, click the link below. Schedule a call with our team at Perspective Wealth. We're here to show you exactly how to invest for your specific situation. I'll see you in the next video.